Well, hello there, and welcome to the pre-show. It's Martin North here. We've just going to let the pre-show run for a little longer, and then we'll get going on the formal show. So I'm going to put the logo up so people know where we are. Great to see so many on. We've got 268 on so far, and great to see some of the old names who've been around with me from the very beginning when I had just 1,000 followers, a few more than that now, and also great to see a whole wave of new people too. It's great. Hi Peter, good to see you there. Zana, hi. Robin, Boris, Leon, Anthony, a few others there. Paul. It's quite complicated now because there's just so much activity on the live stream. So it's great to see you all here, and we've got a really good show this evening. A lot to share, but also a lot of questions. And also, I want to get input and questions from you all. So, I am pretty much there. I'll just give it another 30 seconds. As Cookie says, nearly 39,000 subscribers now. Yep, I think I might get to 50k by the end of the year. That's my target now. We'll see. Fingers crossed. And just so everybody knows, if we get to 1,000 tonight, Cookie Boy is going to make a donation of $400 to a charity of my choice. So let's go and share this with everybody so that we get more people on to try and get over the 1,000. That would be terrific if we could do that, and we could help a charity on the way too. Okay, so I am now going to take that off, and I'm just going to rerun the doom music, as somebody said, or as I say, my introduction. Back in a second. Well, good evening and welcome to the DFA live stream on the 19th of May 2020. I'm Martin North, the Principal of Digital Finance Analytics. Start it again. I'm Martin North from Digital Finance Analytics. Welcome to the show, and great to have you all on the stream tonight. We've got a packed show, lots to talk about, and it's great to see you all on. I see a few people commenting about the doom music. Oh, it's not that bad, is it? I composed it myself, you know. We have, at the moment, 375 concurrent on the stream, so that's great. And we have a lot to get through tonight. So what I'm going to do first is I'm just going to run through a few intro slides as normal. This is for two reasons. One is because there are a few things I want to talk about before I get going. And secondly, it also allows me then to just give you some base information. So this is a bit like the mini DFA daily before we answer the questions. Okay, so just in terms of the running order for tonight, this is a pretty standard conversation, but just this introduction, of course, the house rules. Talk about our models just briefly. I'll go on through some key slides. Then we'll do the Q&A, and we'll sign off typically about an hour and a half, plus or minus. And while I'm looking at this particular part of the presentation, I won't be looking at the chat. So if you have questions, if there are things you want me to look at, then just hang off until I come back to the Q&A a bit later. I will try and keep one eye, but it's quite hard with other thing. That's what I'm doing. House rules, please note, I have to say this is not financial advice. I don't know your personal circumstances. I'm talking in general terms, providing general information based on my research. If you need specific financial advice, then go talk to a financial advisor who can understand your personal circumstances. Please play nice in the chat room, no racial slurs. Plexus is doing a great job in moderating once again, so thanks to Plexus for that. This is at the 19th of May, of course. If this is played years later, well, we'll see how accurate it was. Please use that Walk the World to get my attention, because there's always a lot of activity on the stream, and people often have side conversations going on, and that's fine. I encourage that. It's all part of the community spirit here. But the point there is, if you want to get my attention, then use Walk the World. I've also enabled Super Chat, so if you want to either make a donation to DFA to help us do what we do, or indeed make sure that your question gets noticed, then you can use the Super Chat facility, and some people have already done that already. It's really appreciated. It helps to cover some of the basic costs. DFA on YouTube is not a profit organisation. It's not for profit. We just use all of the costs, all of the donations we get to help cover the costs. In fact, we're using quite a lot of the funding from our surveys to also support the channel too. Now, just on the model, there are some people who may not have seen this before. So we survey households, we survey SMEs and brokers, and we also collect data from other sources. We put it into our core market model, and that allows us then, through our 52,000 household surveys, analyse what's going on. And from there, we run different sorts of scenarios. We provide information flows through to our blog, through to the YouTube channel, and also we sell information to private clients as well. That includes information coming in from the RBA and APRA and other public sources, and also trading information from the private sector too. The critical part of those are surveys. We survey households. The survey goes into the market on a Wednesday, that comes back on a Tuesday. So we are never more than a week behind reality. So that, I think, gives us a bit of an edge. We also slice and dice the data. Think of it like a Rubik's Cube. You can look at it to all sorts of different ways. And I'll show you a little bit of that data a bit later, because I've actually connected the core model to the live stream tonight. So we can actually look at individual postcodes, and I'll show you some examples of that shortly. Now, just in terms of the RBA, they published their minutes today. And the first thing to say is that they said that they expect the GDP to contract by around 10%. And that would essentially be an unprecedented fall in the 60-year history of Australia's quarterly national accounts. So we are in uncharted territory, and probably everybody knew that, but I think it's very important to understand it. Household consumption is expected to contract by around 15% over the first half of 2020. There's an interesting comment just came out from the Fed, who said that in the US, households are saving quite hard at the moment because they're not getting out to spend. So their theory is that households might go out and spend a bit more in a few months' time or a few weeks' time. I'm not sure that's going to be the case. My survey suggests that people are being very cautious, and where they can, they're saving because of the level of uncertainty. Businesses are also grappling with the deterioration in conditions, and they said that they're deferring non-essential investment. We're seeing that in our surveys too. Non-mining businesses' investments expected to decline significantly. Mining investment will be more resilient, although weaker than previously expected because of deferred LNG projects. And they also said that the unemployment rate is likely to peak at around 10% in the June quarter, and that would be, of course, much higher had it not been for JobKeeper. And I don't know whether you saw, but Alan Kohler made the point that around 56 or 58% of all households in Australia are essentially now being supported by the government through one of the schemes. So that is the real damage being done. So, the unemployment rate, as I discussed the other day, is artificially low, 6.2%, but actually 10% even on the RBA numbers. And they're saying it will stay high next year as well. And they also wanted to make the point, and it's quite true, that some people who lost work will not be eligible for either payment. So we have this corner or group of people who are not actually getting any support at the moment. I think that's a problem. They also added that the cash rate effectively has drifted down to 14 basis points. So although they've got the cash rate benchmark at 25 basis points, actually the market is lower than that at the moment. And that's a combination of their interventions in the market. So basically the banks can get really, really cheap capital as much as they want, and that's definitely having a significant input. They also basically made the point that the cost of funding at 25 basis points is available by the bank's term funding facility, but in fact the banks are hardly using it at the moment, again, because they can get cheap funding elsewhere. And what they are doing, though, is using the 25 basis point funding from the RBA to replace more expensive funding. So there is huge downward pressure on the funding of the major banks, particularly, and the regional banks too. And that's being translated in lower interest rates, of course. Now, in terms of mortgage stress, they say around 1/3 of households with mortgages have prepaid buffers for 3 years or more. I'm a bit sceptical of that number. You all know why that is from my earlier conversations, because I think they're probably taking a rather more market view than they should. But a smaller share have no mortgage prepayments and are more susceptible to financial stress. I'd agree with that. Home loan arrears are likely to increase, but the extent will depend on the severity of the economic contraction and the associated increase in unemployment. Yeah, well, that's stating the obvious, isn't it? Unemployment, of course, is going to be higher. People are going to be struggling with those mortgages. And, of course, once we get past September, that's when things get really sticky, I think. And they also make the point that commercial property is going to be significantly affected. I think this is probably one of the most critical things to watch, because what they're saying is that there is a rise in vacancy rates, that office rents are likely to fall, and that could lead to lower valuations, and that could pose challenges for leveraged property investors and developers and the banks. They didn't mention the banks. The banks are quite leveraged into commercial property too, and if you add the commercial real estate to the residential real estate, more than 70% of bank lending is leveraged into the property sector. One reason why the Reserve Bank and the government doesn't want to let property prices fall. Now, the ABS came out with data today saying that the total payroll jobs fell by 7.3% from mid-March to early May. And it varied a bit by states, but in New South Wales, in Victoria and New South Wales, falls were around 8.4% and 7.7%. And unfortunately, payroll jobs for people under 20 continue to show the largest fall at around 14.6%, and were particularly high in some states and territories such as the ACT at down 19.2%. And the accommodation and food services industry lost around a third of payroll jobs, and that was by the week ending 11th of April. And subsequent, they saw a reduction of 27%. The decreased number of jobs in the week ended 2nd of May was 1.1%, and was only slightly larger than the 0.9% increase in the 25th of April. So this is not good news. And remember that this is looking at what's called the one-touch payroll system. So about 99% of substantial employers, so that's with more than 20 employees, and around 71% of small employers, 19 or less employees, are currently reporting through single-touch payroll. So that's the data that they're using. It's not complete, and it is masking, I think, very significant problems in small businesses under 19 employees. And certainly my surveys are showing it's going to be even worse than this ahead. So this is not good. Now, of course, in terms of responding to this, there's been all sorts of responses. Victoria announced today a $2.7 billion stimulus package, including school infrastructure at $1.18 billion, upgrades to 200,000 public and community housing properties, and building 168 new homes, $500 million. Now, there we go. Build a few more properties, that will solve it. What this is about, though, is essentially trying to get people back into jobs. So they're looking for transport upgrades. They're looking to new experiences in the tourism destinations area as well, and also upgrades to the CFA and SES stations, and a fund to speed up the project, 180 million. And the state government over there has said that they've given the green light to borrow up to $24.5 billion to fund its coronavirus response. So this is, I think, example of what we're going to see. We're going to see a lot of this, a lot of money being thrown at various programs and projects. And in fact, this is about giving people more work. It is actually not necessarily going to build a lot of new stuff. It's really upgrading a lot of older properties, which probably needs it anyway. And I think about a quarter of it is going into the regions in Victoria as well. So I'm expecting to see more of those programs. Consumer confidence is still low. This is the latest ANZ Roy Morgan. It's actually come up a little bit from where it was, and it's now only 5% below the long-run average, but overall sentiment is closer to 20% below average. They say it seems reasonable to expect further gains in sentiment. I'm a little less sure myself. I think that people are hanging out to see what's going to happen, and there's a level of uncertainty. Obviously, getting back to work, opening up a little is helping, but the fundamental financial pressures that people are under, I think, is a big deal. Now, ABC did a thing today, both it's in the news this evening and also online, talking about interest-only loans. I actually contributed to that program. And they made the point that with home prices falling by 11%, there's a chunk of people on interest-only loans that probably still will need to move back. And so there's a big debate about what to do about that. Some politicians are asking for more people to get into the interest-only loans. And in fact, the regulators have allowed the banks to offer interest-only loans to existing borrowers to help them. So it's interesting times. I think that we're going to hear a lot more about this. And that 730,000 investors, I don't think all of them are going to be requiring to repay this year. About 120,000 is my estimate. More negative property news as well, again from the ABC. The Real Estate Institute of Tasmania said the number of house sales was down 27.5% across the state for the month. Hobart, the decline was 37%, Launceston 39%, and the Northwest 12%. And house prices declined by 2.2% statewide, but 14% in Hobart. And whilst vacant land sales increased by 1.6%, there was an easing of properties for sale in the $500,000 and above price bracket, and those properties are still selling just above the listing price. But they concluded that the focus of a lot of buyers is obviously much different from where it had been in the previous 6 months, and not as many people out there thinking about putting their property in the market, indeed buyers out there to purchase. So this is another snapshot on the story of the property market freezing up, slowing down. And the question is, how long will it be before it comes back, and will it come back? Now, talking about that, I've done a few conversations with Harry Dent, as you may know. In fact, the conversation I recorded with him last Saturday, which was, is now the time to get out of property, which, by the way, Harry thinks it is now the time to get out of property because there's going to be further falls, was picked up by the Daily Mail, and it was picked up by 7 News. And they actually incorporated elements of my show in their post, which is fine. I'm happy for them to take and use what they want to use. So I've got a bit of coverage there. And I'll come on later in the show to talk a little bit about the live event that we're running on Sunday, I should say, where we're going to talk with Harry and with Robert and a few other people about what to do at this time. Now, a few other points. This came out today from John Volk, and he made the point that the CoreLogic index is falling if you look at the annualized momentum. And that's the way to think about it. So we had some growth earlier on, but that's decaying now. And remember that these indices are a bit late anyway to the party, so it doesn't really tell you too much, but I think the momentum is definitely easing off. And the RBA is signaling more trouble ahead. So they're saying that the residential approvals will continue to slide, and that they're saying that the house price growth expectations looks to be definitely on the ease. And of course, CBA came out and said 32% drop. Shane Oliver at AMP is saying 20%. ANZ saying 10%. Some people... I wonder who that could be. Mr. Joy is saying, no, prices will be definitely up in a couple of years' time. So there are people on the other side of the equation as well. It's also worth making the point, and this is what the Reserve Bank said, that the auction withdrawal rates gone up. This is for Sydney on the left-hand side there. And SQM Research published data today to show that the scheduled and cleared auctions were pretty low again. A few did sell, but not many. And if you compare this with a year ago, then the volume is very much lower than it was. Now, just abroad a bit, Canada is also being hit. So this is not something that's just local to Australia, right? So one of the things we need to understand is that the property markets are being hit around the world. Canada is a very good analogous market. And in some ways, they are actually giving us more up-to-date information than we get out of our own market. So they said that the national home sales fell 56.8% in a month-over-month basis in April. And not seasonally adjusted was down 57.6% year over year. And the number of newly listed properties decreased 55.7% from March to April. And the house price index edged back. It's still up for the year, but is now moving back. And interestingly, they show these charts. So basically, sales fell by 66.2% in Greater Toronto, 64.4% in Montreal, 57.9% in Greater Vancouver. These are, I think, the sorts of trends that probably we will see ahead as well. So it just shows you that it's happening elsewhere. And this from Bloomberg, if you look from the 19th of February, which was the peak of the US market, to now, it's 3 months. And what they did was to chart all of the different types of assets from then to now. And basically, their baseline is at 100 back in February, and they've shown the divergent movements. And you can see there on the right-hand side that the S&P index is down, the FTSE is down, the Russell is down, the New York FANG is slightly down, NASDAQ slightly down. So the tech stocks are doing a lot better than the rest. China's down a bit. Euro is down. And you can look down. But look at gold. Gold's 107. So the golds have gone up, not surprisingly, but The real star, of course, is bonds. So you can see there that the 20-year plus Treasury, one near the bottom, is 112. So that gives you a bit of a flavour of the diverse movements in different asset classes. And if you talk to Harry, Harry will say, should have been in bonds. He's probably not wrong. And just so another chart from Bloomberg, that the real estate trusts and bonds have diverged. Interestingly, they used to track much more closely together, but something's changed. And I think it's because real estate trusts are really under the gun for the reasons that we discussed earlier on. So I'm expecting to see significant long-term pressure in the real estate sector through the trusts. And that, of course, then flows back into super as well, even here in Australia. That's an interesting observation too. And the EU agreed to a 500 billion euro recovery fund. Now, there's been a big debate, as you know, I've been talking about this, between Germany and France and the rest of the European community about what should they do. Should they bail out Italy and other places? So what they've done is to agree essentially a fund which will be effectively not a loan. It will be a sort of a fund that's available to be drawn upon as required. And those euros will have to be repaid, Macron said, but not by the beneficiaries. So they've sort of muddled their way to a little bit of a solution, but it's not enough. You know, if you think of the 3 trillion that the Fed has been messing around with, this is just not enough to be able to solve the problems in Europe. Europe, I think, is the real bellwether for the problems that we're going to see ahead. Okay, now in terms of our scenarios, so just as off the back of the model, we run our scenarios, and we've updated our scenarios once again to take account of the latest information, all of those different sources coming through, and then running it through our model. And so we now have what I call the RBA baseline. So RBA basically updated their scenario. So I'm looking a couple of years out, so I've got an unemployment rate now at 7%. I've got mortgage stress at 38%. I've got bank losses at 12.5% on the assumption that the central bank will support the banks. And I've got in this scenario now a potential for a small home price rise over the next couple of years at one end of the spectrum, or a small fall. It's that sort of close, and it depends a little bit on which segment you look at. And I've now given that a 5% chance. Now, that is the scenario that Chris Joye would want to see, and he would refer to the modelling that was done by the RBA by somebody called Mr. Tulip. And Mr. Tulip has a model that basically says when the interest rates are cut, that allows credit to grow. That growth in credit stokes house prices. So that's the model that effectively Mr. Joye is talking about, right? I give it a 5% chance at the moment, no more than that. The next one is what I call the best case. So this is what I think could, if everything went really, really well, we could get away with. And that's whether a cash rate that's lower than 0.25%, I've adjusted that down, unemployment around 7.5% in the next year, mortgage stress still at 40%, the bank loss is higher, 18 basis points, home prices down between 5 and 15% on average. Varies a little bit, some will be higher, some will be lower. And I've now gotten that a 7.5% chance relative to a 5% previously. The next one is what I call a longer term crunch. So this is where effectively the economy struggles to restart, where the unemployment rate is higher. So the unemployment stays at 8.75%. We've got that very low rate again. We've got bank losses higher, we've got mortgage stress higher. And in that scenario, home prices on average could be between down 15 and down 30% across the country. The 15 will be, for example, inner ring houses in Sydney and Melbourne. The 30% will be those on the urban fringe and high-rise as well. High-rise probably even more badly affected. Some of the other states not so bad, so New South Wales is going to lead the way, then Victoria. Brisbane not quite as much. Over in the west not as much. But I think Tasmania and Adelaide will probably see 10 to 15% falls. And I give that a 45% probability now. So I've actually moved it around a little bit. It was 35% last time. So you can see what's happening is that the scenarios are just morphing a little bit from where they were. My global disruption scenario, which is, of course, at one stage when they didn't have the pandemic under control, was where I thought we're going to end up, is now a 32.5% probability. And there we've got higher unemployment, we've got zero real rates, we've got mortgage stress very high, we've got bank losses high, and we've got home prices 30 to 45%. So that's the scenario that essentially Harry would probably suggest would be likely to happen. So, it's definitely there in my scenarios, not quite as strong as previously, but still pretty strong. And then we've still got the risk of an uncontrolled pandemic. So if we get another pickup and if it starts spreading again, then all bets are off. I still got a 10% chance because I don't think we're out of the woods yet. But I haven't really done much more with that particular scenario at the moment because I think it's now going to be a question of best case, longer term crunch or global disruption. My expectation is that as the return to work begins to bite, it could be that we begin to see the probabilities change so that we get perhaps lower home price falls than the worst case scenarios a month, 6 weeks ago. But we'll see. And, it does vary, of course, by bank. It does vary, of course, by borrower. But that's on average where I think we are. So that's the summary. And that's what I'll be publishing tomorrow on the DFA blog as well. All right, now we're going to go to the Q&A. And just before I start looking at the Q&A, I just wanted to introduce you to our mortgage stress. This is a chart that I showed you last time. And mortgage stress, of course, is a cash flow measure, money in, money out of households. But it's a subset of the total view on financial stress. And what I wanted to do was to introduce you to my core market model. And this is, in fact, the core market model output. I'll make it big on the screen there so you can see it. So this is effectively hardwired now into my core market model. I've put up two postcodes. I've put up Melbourne postcode 3000, which is the CBD of Victoria. And I've put up the postcode 2000 in New South Wales, which, of course, is the CBD. And we can go down the list and I'll just explain the data that I have available, right? Firstly, how many households live in the postcode, and it's quite interesting to compare the two. So 22,900 in Melbourne compared with 13,800 in Sydney. And of those, how many are borrowing? Well, around 3,000 in the case of Melbourne, that's mortgage borrowing, 1,700 in Sydney. We've got a lot of renting, so 18,457 in Melbourne and 10,938 in Sydney. And then we say, well, how many of those then are registering as in mild mortgage stress? And mortgage stress is basically cash flow, money in, money out. Mild stress means they don't have enough to take account of all their obligations, even allowing for things like the various government support mechanisms and the interest and principal repayment holidays. So 151 compared with 246. There's none that registered in severe stress in these postcodes. So severe stress will be when you've got deep problems with your cash flow. And in this particular postcode, not too many. But the really interesting thing is the rental stress. So in Melbourne, we've got more than 18,000 who registered as rental stressed, which surprised me. But when I started looking at it, some of them were students, some of them were young affluents. You can see there that the predominant segmentation lever is shown there. It's not the only one in the segment in the postcode, but it's the segment of predominance. And so they're the young affluents. And if you then add the mortgage stress and the rental stress, you've got total financial stress there of 81%. So in that postcode, there is a lot of financial stress ticking away below the surface. It doesn't mean that people are going to fall over tomorrow, but what it does mean is that a lot of people are going to find it very difficult in the months ahead, and will spend less, and will put more on credit cards, and will raid savings where they've got them, and basically struggle on. I think quite a few of those who are in rental stress are also people perhaps in education, and maybe students. They seem to be one of the other elements of the figure. In Millers Point in New South Wales, it's a very different scenario. We don't have the same level of financial stress. It's only 5.9%. So it shows you that there is a very different dynamic between those two centres. And in fact, looking at Victoria versus New South Wales, it looks to me as though Victoria's probably got more issues. One of the reasons perhaps why they are giving more of a stimulus now. Okay, so with that, let me come back to the main cam. And I'm just going to now have a look at the chat and basically see what we have in terms of questions. So this is from Jam saying the property areas in Sydney in which I'm looking have already dropped 10% through January, February and March. Was very buoyant, yeah. Well, it varies. So in some areas, prices are still really hardly moving at all. But if you look carefully, you will see there are some significant drops now. I'm looking at Western Sydney quite often, see price drops there. I'm looking at high rise, a lot of falls there as well. So it does vary. Okay, so Richie says, if global property busts simultaneously, what would that mean for the financial system? Well, it's a good question, and of course nobody wants to think about it. But essentially we know that the financial system and the property sector are very strongly linked. Now, the amount of lending that's been done here to the property sector is much higher than any other country around the world, even places like Hong Kong, for example, or even maybe China is up there as well, but not quite as much as we, pretty close. But in the US, a lot lower. So it's going to vary, I think. What it will do is put a lot of pressure on the banks and their ability to lend, because they're going to have to provision much more. And of course, they could well be stuck with a lot of assets that are effectively undervalued compared with their book value. Now, it's quite likely that we will see central banks buying portfolios of properties off the banks. Good bank, bad bank is the strategy, so that effectively they can keep the banks ticking over, and essentially those will be held by the central banks. I think that's probably what they'll do, because if they don't do that, then this could trigger a very significant correction, not only in the property sector, but also more broadly in the financial system. And there is still a significant risk of a financial system collapse. So that's what I think they will do. It's a tricky time, very tricky time. Okay. Now, Bob says, could you talk some more about scenarios that would stop governments printing money? What are they? How likely? What the effect? Well, look, the only way that governments will stop printing money is if the population turns around and says, you can't keep doing that, we refuse to accept it. But at the moment, everybody is just saying, okay, that's fine, just print a bit more. You know, the Fed's printed a lot. I did a post the other day and just showed how much had been printed, you know, sort of 30-40% since the last year. There is very little at the moment to stop this money printing. Most of the central banks around the world are on the same train in terms of print, and they're putting a lot of that liquidity directly back into the financial system. So you need to understand that a lot of this is to do with supporting the financial system rather than the real economy. So even if you look at some of the schemes to support households and businesses in the US, you know, it's a small proportion of the total amount that's been created and printed. So what's happening, as I've explained before, is that essentially you have governments who issue more bonds. Those bonds are then bought by the central banks. So both sides of the balance sheets go higher. That basically inflates the amount of money in the system. But, and this is the tricky part, if that money is going into the financial system rather than into the real economy, what it does is it can actually be deflationary rather than inflationary. And this is a very contentious discussion, because many people are very much of the view that the future will be high inflation. In other words, all that money printing will lift the cost of everything, just like it did in the 70s and 80s. But remember then that interest rates were much higher then, firstly. And secondly, the financial system was not as strongly developed as it is today. Now, when that money goes into the financial system, what that then means is that the investment managers in the financial system will be then going and investing in other assets. So we're going to see some assets inflating at the same time as other assets, like property, could be deflating. So that's the problem. And that means that you may well end up with a bigger economy, bigger numbers, but not necessarily more value. Now, there are other people who say, no, you can't go on forever. There has to be a limit to how much you can print. To which I reply, well, look at Japan. 200% of GDP, still printing like mad. The central bank in Japan has bought junk bonds, they bought all sorts of things. They bought stocks, they bought EFTs. You know, if it moves up, they bought it. Something like 40% of the total economy is now owned by the central bank in Japan, and they're still at it. So there doesn't seem to me to be any stopping point. And the trouble is, actually, once you go down this route, it's very hard to climb back out of it again. You know, the Fed tried a couple of years ago and failed miserably. It was called basically by the market. And my worry is that this will just go on and on and on. So they'll print more and more and more. The size of the debt will get bigger. Trouble is, of course, that debt ultimately needs to get repaid. The other final point to make here is that if, in fact, interest rates start to rise, which is feasible in an inflation scenario, it means that the costs of all that borrowing starts to rise too, and that becomes a brake then on the entire economy, and that then leads to this deflationary activity in an inflationary environment, which is stagflation, of course. So that's another scenario. So there's a lot more work that needs to be done, I think, to look at these alternative scenarios. And there are people out there who are very fixated on a particular solution set, because if you think that inflation is going to be the way, then you go gold, because that will protect your assets. If you think deflation is likely to be here, then gold is a less good thing to do, and you go another route. So it does depend on how you see it. I'm still of the view that it's not clear as to how this is going to play out yet. And it'll be one of the things that we'll be discussing the weekend as well. Okay. So this is pacifists saying, what level of loan book value decline before the banks are insolvent? Likewise, what default rates make them cactus? Well, it's an interesting question, because the default rates, if somebody defaults, right, there's a few things that they can do. The first is, if they got lender's mortgage insurance, they can actually activate the lender's mortgage insurance. And I expect the first point of pressure won't be the banks, but with the LMIs, that's sort of people like Gemworth and QBE and the captive lender's mortgage insurers inside some of the other banks. Beyond that, if the values continue to degrade and are permanently degraded, banks have to take account of that when they actually make their provisioning. Now, at the moment, very few of the banks are really taking account of what I think the real falls are likely to be. And when CBA comes out and said it could be 32%, that's their worst case scenario. They're saying 11% is most likely. They should be probably marking their books down by 11% already. Probably not yet, but they should. Now, when they do that, that means they have to increase the amount of capital that they hold for those particular loans, because the amount of capital you hold is a small proportion of the total value of the loans. So even if you move the capital ratios up a little bit because of the higher risk, the amount of capital is not huge. And that's one of the things that people need to understand. This is a highly leveraged model the banks have, and they will have to hold slightly more capital, but not a vast amount. But there is a tipping point. There is a tipping point at which suddenly the amount that they have to hold jumps. And that is at the point where the risks in the portfolio really escalate. Now, it's hard to know when that is, because the banks, the main banks anyway, are using their own internal risk models, which are not made public. So we actually don't know how they assess the risks in their portfolios. APRA is meant to be looking at them and making sure they're okay, but they don't do a very good job of that. So we are totally reliant on the banks essentially auditing themselves. And even their internal and external auditors don't really get very close to this. So there's a real black hole here as to how much the risk is. My own view is that defaults of 2 or 3 or 4% will be manageable. If defaults started to get to 6, 7, 8, 9, 10%, that's when it gets really, really serious. That's when bank capital would be significantly eroded. But even then, the banks will be supported by the Reserve Bank and by the government. Either they would buy those bad loans off them and just hold them in the public purse, or they would actually inject more capital into them directly. So that's how I think it's going to play out. I'm less sure now that the deposit bailing is likely to trigger. I don't think it will. I think that we will see bailouts from government in that scenario. Hopefully it won't get there, but that's what I'm seeing. Okay. Now, Jam says the problem with house prices are that they are only fed into models on settlement data, 42 days too late. Well, you're right about that. There is no good source of data. Well, there is. There's data put into the real estate systems by the agents when properties are actually sold, but that information doesn't get through to us. We don't see it. They do have it, but they choose not to disclose it. And quite often, only when you get to settlement do you actually know And of course, the settlement process then takes 42 days. That information then goes through the public system and eventually gets into the indices. So the CoreLogic Index is ultimately based on information 42 days behind reality. Now, they claim to have alternative mechanisms to be able to check and bounce. I don't know what those are, don't know how effective they are, but in the current environment with very, very low volumes, market discovery is pretty much non-existent. And market discovery is required to know what prices are. So chances are prices are falling. We know that asking prices are falling. We know that people are settling lower in some areas than their asking price. But people are still holding out in other areas and preferring to take the properties off the market rather than on the market because they still want the price. So this is going to take a bit of time to play out, which is interesting. If you look at the US, after the global financial crisis in 2007-8, it took 2.5 years for the full effect to flow through into home prices. And that's one of the reasons why I'm saying that home prices are likely to slide for a period of time that's probably 1 to 2 to 3 years before we get to the bottom, before it moves up again. Okay, Charlie says, what do you think home prices will be in Sydney on average by the end of the year? Well, on average, it doesn't tell you very much at all. I think that you will probably see units and apartments, particularly in those high-rise areas, down 20 to 30% in some areas. I think that we will see houses on the urban fringe down maybe 100,000 from where they are. And I think we will see some of the inner suburban properties that are detached houses on relatively good blocks in good locations with limited demand and limited supply, a lot of demand, probably hardly moving. So it varies. And that's the problem about averages. And I get really cross with people talking about averaging because averaging doesn't really give you a lot of good information. What you need to do is to go granular. Otron says 100% in Melbourne. No, it wasn't 100%. It was 80.6 in mortgage stress. In rental stress. No, only 0.7 in mortgage stress in that postcode. Okay. Ant says, evening, hello. Enjoying the show tonight. Do you have a favourite regarding the big four? Looking to get some exposure into banking sector for a long-term hold. Well, actually, they're all interesting. They've all got problems. My own view is that if you are in it for the long haul, I think CBA is probably overpriced. That's my own personal view. You know, I think NAB is underpriced at the moment based on its long-term credentials. So my own view is NAB's probably one to think about, but only if you're taking a 5 to 10 year view. They've got huge issues to work through, but they have a big franchise. They have a very good footprint into the SME sector in particular, which could actually give them benefit later. So I'd probably go there. That's not financial advice. That's just my own opinion. Okay, now this is Peter saying, hiya, a bit of a newbie here. Hello, Peter. How much QE has actually been created globally in the last decade, and what percentage has been created by the US and the EU? It's a very good question. I think that if you tot it all up, and it depends a little bit on what you count and how you count, right? We know that the Fed inflated their balance sheet to 6.9, 6.8 trillion, and before the immediate crisis, it was down at sort of 3.9 to 4.5, that sort of range. So there's 2 to 3 trillion sitting there, right? If you go back another decade or so, the Fed's balance sheet was a lot smaller than that. So the Fed in the US has created probably an additional 5 trillion, something like that. The Eurozone, not as much as that, maybe a couple of trillion, maybe slightly less than that. Bank of England's done some. Bank of Japan's done some. So, you're starting to talk quite large numbers. But it is actually quite hard to know because there are all sorts of different ways of printing money. And some people would argue that some of the methods that are used are not quantitative easing. Others will say it is quantitative easing. So, it depends a little bit on how you look at it. But yeah, it's a big number. Okay, now this passage had said, how will sustained reduced rents trigger price falls? What's the mechanism? Okay, so if people are paying lower rents and you're a property investor, it means that you will not be able to get such a strong income flow as you have previously. And that means from a net present value calculation perspective, your income flow is lower, which means that what you will be prepared to pay for the property is lower, especially if you don't believe there's going to be any capital value. So property investors over the last 20 years have basically been in it not for the rental flow, but for the capital flow, for the capital value, for the inflation effect of home price growth, stoked by very cheap lending and cheap money. Now, the fact of the matter is that if you take it away, and if you do the calculation based just on cash flow, even if you take account of tax breaks and those other things, most property investments are underwater. About 60% to 70% are underwater without capital gains. So if you believe that there are no capital gains ahead for the next decade plus, and if you believe that the true story is going to be an oversupply of rental property, it means that being a property investor is going to be very, very uncomfortable. So, two things. One, there's likely to be more property investors deciding to sell to get out, and we're already seeing that. So there's about 8% of property investors looking to sell. Around half of them were ex-Airbnb, by the way. And you've also got an increased supply. Demand is down too, because many investors will say, oh, I'm not sure I want to get into this at the moment. And first-time buyers probably won't be sufficient to mop it all up. So supply-demand equals lower prices ahead. That's the mechanism I think will be. Plus, of course, a lot of them with these high-rise apartments thrown together, relatively poor quality construction, and now risk having a lot of maintenance costs. And one of the things I say to people is don't go and buy some of those newly thrown up apartments without doing really, really powerful due diligence, because the costs are enormous if you have lots of cracks that need repairing. You know, Mascot Tower, for example, I think it's 40 to 50 grand per unit now. Many people can't afford that, and they've got the horrible choice then of going bankrupt or taking a bigger loan. Neither is a very good scenario. Okay. What else? Okay. How will sustained reduced rents trigger house prices fall? We've done that one. Yes, prices are definitely going down. I have all New South Wales prices from 1990, and I'm starting to see April sales. They are lower. Best to ask agents what they sold in the current stock out. There's current stock out. Yeah, I agree. Very low volumes. The other thing, of course, is that many real estate agents haven't sold anything for quite some time. So from a commission perspective and from a earnings perspective, a lot of them are actually struggling at the moment too. Okay. Any thoughts on New Zealand property market? Similar to ours or different? Another Martin. Hello, Martin. Well, yeah, there are differences, but there are very similarities. So it's stoked by the same credit boom. The Reserve Bank in New Zealand is using the property sector to try and stoke the economy. We know that for sure. We know that prices have been quite strong. We know that loan-to-value ratios have gone up relatively recently. But we're also seeing now some easing in terms of volumes and easing in terms of prices. So I think we're going to see a somewhat similar trajectory. Whether it will be as severe as in Oz is difficult to tell, because on some ratios you're higher, on some ratios you're lower than Australia. But I think you can assume a somewhat similar path. Joe Wilkes and I will be talking about this quite soon. We've got a plan to do a bit more on New Zealand now Joe's back. So we'll try and cover off that in more detail then. Now, that's an interesting one. Cookie Boy says, could higher oil prices delay a V-shaped recovery? Well, it's certainly feasible. Remember that some people might have bought oil when it was really cheap, and sort of if they got somewhere to store it, but many people didn't. Difficult to know where oil prices are going to go, and the chances are that that could be inflationary later. So it will definitely be one of the factors. I think it will be the most significant factor. To me, unemployment is going to be the most significant factor. If unemployment is truly at 7% or more at the end of next year, that's going to be a really, really cruel blow for the economy here. And that's going to be sufficiently strong in terms of unemployment to really suck the air out of the economy for a long, long time. So in a way, I think unemployment's probably a better indicator than oil prices. Maria says, what should I do with my money? I don't own a house. What about was about to buy, then COVID happened the day after approval. Yeah, Murphy's Law, isn't it? Yeah, look, I think you can do probably better later with house prices. I think house prices will fall. So I could be wrong, but that's what my view is. We're already seeing so many signs of prices falling. I don't know where you're thinking of looking. So I would wait a little bit. Then, of course, the question is, what do you do with the funds in the meantime? So some people will try and play the markets, but the markets are very unstable at the moment. There's a lot of volatility. They're going up at the moment. There was a very strong rise in Australia today, very strong rise in the US. That was partly driven in the US by an announcement that one of the drug companies had passed the first phase of COVID testing, but one of three. It was also, I think, probably reflecting the news that the Fed has basically said they're going to buy anything and everything for as long as it takes. So further confirmation of this magic money machine that they're developing at the moment. So I think it probably is worth just holding off. My own strategy, I went to cash some time back, and I'm sitting at the moment in various term deposits. They're not great, but they're okay. And at least I know where the money is, and I can get it out if I need to get it out. What it allows me to do is to have the flexibility. I didn't want to lock myself into other asset classes because I felt that the likelihood was that there would be falls rather than rises from this point. And, I'll bide my time. There will be an opportunity probably to go back into the market or even back into property, but pick your time, I think, is the trick there. Now, Zane says, can you do a show around the top 10 banks? Who has biggest balance sheet risks? Yeah, that's a tricky one, right? Because there isn't enough disclosure to know, not in Australia. Now, in New Zealand, there is more information. So the Reserve Bank in New Zealand has a sort of a scorecard for each bank, so you can actually make some intelligent guesses. In Australia, it is extremely difficult to know. There is not enough disclosure, and therefore it's almost flying blind, so it's very hard to know. What you can look at is you can look at how much of their book is mortgage exposed, and Westpac is probably right up there on investment mortgages. CBA's got a huge pool, NAB and ANZ slightly smaller pools. But then you've got to think about the types of mortgages that they've written and their underwriting standards. It's complicated. Sorry, I can't give you a simple answer to that. How will this debt get paid back with reduction in migration and low productivity? That's from Daniel. Well, now, there's a really interesting question here about, is debt to be paid back, right? So there is an argument that says, look, with interest rates so low, and they're going to stay low for years and years and years, banks and central banks and governments can afford to borrow big, and providing that they can invest that money into productive growth and create more value than the cost, they actually don't need to repay the money, because eventually the size of the economy will grow, the debt will get squeezed, and it will therefore be smaller when it's paid back many years down the track. And that's one school of thought. The MMT sort of guys are in that camp. And I have got some sympathy for it, because rates have never been so low. Rates are as low as they have ever been. You can raise funds for almost nothing. And that does give you an opportunity. But the question is, what do you do with the money? If you are actually raising money and you're using it to prop up people in the short term, or make poor investments, for example, buying up defunct property, for example, you could end up actually spending a lot of money with not getting a significant return. So to me, the question becomes what you can do with the money. If you can actually invest it in productive things that creates more value than the interest rate, then great, that's a good thing to do. And there are things you could do. There's infrastructure that we need in Australia. Absolutely there is. high-speed trains and all sorts of things we could do, the greening of the economy, all those things. The question is, will we do that? Or will we actually just say, right, let's throw a bit more money at the property sector, let's build a few more properties, let's bail out the banks a bit more. And yeah, that's my concern. We could end up just sort of going around the houses, literally, once more. I have an IP unit and in the process of listing it to solidify my gains. Hopefully, I'm interested in seeing, it's Western Sydney, more houses being listed than units over the past few weeks. Yeah, it is interesting. It does vary, don't know where you are, but there has been some variation there. In some places, there are quite a few units coming on the market. In other places, not so many. So you might be lucky. Maybe it's is it an old one or a new one? I don't know. But my worry is people who are holding investment properties in these large, relatively new properties that have thousands and thousands and thousands of very similar is the problem. Because there, valuers are now valuing properties at between 20 and 30% below where they were even 3 months ago, and that's a problem. Whoops, missed that one. Have a look, see where else we are. Please talk about the ACT, says Lida. Well, the ACT is the public sector, of course, and the ACT are strongly connected, right? So we know that probably ahead there will be a need to bear down on public sector employment, but not in the short term. So my expectation is that there will be quite a lot of momentum there in the short term. In other words, the government will throw money at the problem. But at some point, as they begin to try and dial back the spending, the public sector will probably be under the squeeze, and that means that Canberra will be under the squeeze. And properties in Canberra have actually not done too badly. If you look at units, some of them are coming down a little, houses less so at the moment, but they're still rather expensive. So if you give me a particular postcode, I can tell you about the mortgage trust in a postcode in Canberra if you want. Deepan said, where do you see Wollongong surround prices going over the next 6 months? Down. Not dramatically down because they never rose, but my modelling suggests that there is quite a lot of supply. The demand is quite limited, and as prices drop closer into Sydney, we're going to see people perhaps looking closer in relative to Wollongong and the areas like where I am. So that's what I think is going to happen. But prices have not dramatically risen compared to other areas. So there's probably less of a downside, but almost no capital growth, I think, ahead. Okay, now Tom says, why are property owners not panic selling before the 30% price fall predicted by CBA? I think, Tom, and thanks very much, by the way, for your contribution there, I think it's because people don't believe it. If you look at what people are thinking at the moment, and I see it in my surveys, a lot of people are actually still quite bullish about property, even now. I still get the property prices will double every 7 years, despite what some of the mainstream economists are now saying. So we are wired, because that's been the experience over the last 30 years, to see prices always rise. And, if you think about it, that is an abnormal 30 years. It's to do with deregulation of the financial system. It's to do with the cutting of interest rates. It's to do with the loosening of lending standards, and it's to do with the focus on driving the economy from the Reserve Bank through the property sector and through household expenditure. All of those things are essentially coming to an end. And that's one reason why I don't believe that we're going to see strong property price growth ahead. And then it's a question of, well, how much or how little and over what time frame. But a lot of people haven't got it yet. A lot of people prefer to pick up the spruiking comments from all the newspapers. Even I saw it on the TV a little while ago. People say, oh, no, everything's going to be fine. We've got Chinese buyers coming back in. There's already a lot of news about prices going up. And I even saw an article today saying, well, if you look in the last recessions, after 5 years, prices were higher. So it's going to happen again. Maybe, maybe not. But to my mind, things are a little bit different now. I think we've got a different set of circumstances. And remember, I keep coming back to higher unemployment. Unemployment is a real killer, because basically it means that people can't afford to get those loans. The banks tighten their lending standards, and as prices fall, the banks won't extend as much credit. And as you may know, if not, I'll just explain it again, property price movements are directly correlated to the rate of change of credit availability. If credit availability rises, property prices go up. If credit availability goes down, property prices fall. And that is because most people need to borrow to be able to buy property. And so there's a simple correlation. It's one of the things that I keep coming back to. And the banks will be pushing credit, They're actually allowing people to roll over their principal interest for 6 months, and that will increase the size of the bank's book a little bit. Not much, but a little bit. But the fact of the matter is, if credit availability is tightened because of unemployment, because of high tighter lending standards, because of higher capital requirements, that means that the average mortgage will come down. It should come down, by the way. The 7, 8, 9 times income that is still being applied in some areas is just way too high. It should be 3 to 4 times, in my view. That's a safe and secure lending regime. But just think about the implications on house prices, right? If we're going to get back to that, we've got to see house prices drop 20 or 30%. And I keep coming back to this. On a long-term basis, looking at all the data that I've got, house prices are 40% overvalued over their long-term value, which is why I still come back to this horrible view that in a worst-case scenario, if everything goes wrong, we could revert to that mean trek, which means that we would actually be looking for a 40% reduction in prices. Not my main scenario, not my only scenario. It always gets taken out of context, but that's the reason why I say that. It's a combination of credit availability or lack of it and long-term trends. Now, Ricky said, do you believe that banks will introduce a 40 or 50-year mortgage such as Japan, meaning house prices will increase and people will be in debt for the rest of their lives and to the next generation? Yeah, it's quite possible. I think that's one of the levers they will pull, because they are desperate not to allow property prices to fall too far. And the only lever they've got is, well, changing the ratios. How do you change the ratios? Extend the life of the loan. If you extend the life of the loan, the banks love it because they get more interest over the life of the loan, but the repayments will be slightly lower. But of course, there is a point when you start, if you start looking at that you end up paying 2 to 3 to 4 times more interest over the life of the loan than you would if it was a 25-year loan. And the question is, do you want to do that? Right? Is that really what you want to do? And my own view is there is a self-limiting element to that, which means that there is not necessarily going to be massive demand for very long-term loans, or intergenerational loans, as I call them. Now, Mick says, where to put super, assuming not self-managed? No one seems to have gold as an option. Well, look, gold is definitely there, and there are people, and I'm not a gold bug, but there are people who believe that gold is there and tangible, and, at least you've got something firm. Or do you? Now, the fact of the matter is the gold price is driven by 2 things: physical gold and then all the exchanges of the futures and options, right? Those 2 things are somewhat linked, although they do depart from time to time. And my own view is it's very hard to know the value of gold's going to be. So if you take Harry Dent's view, he says, no, gold's going to be under $1,000 in 2 to 3 years' time. If you talk to other people, they're talking 10,000 or 11,000. I don't know where it's going to be. And so can you risk that range of scenarios? Don't know. Maybe you can. Maybe you'll take a view. Maybe you think that the gold bugs are right, in which case that gold might not be a bad thing to do. But on the other hand, if gold drops, then in a deflationary environment it could, then it may not be the best option. That's the problem, really. You have to actually try and pick a scenario and then run with it, or you try and build in some flexibility. So one of the things that I quite often say is generally spread your risks. You may have a bit in the stock market, a bit in gold, a bit over here in deposits, and then you sort of ride it up and down. Now, some people do that. Other people say, no, I want to put it all into Bitcoin or all into gold or whatever. So it depends on your risk appetite, depends what time frame you want to be over. But I would say the Bitcoin is at the most speculative end. I'd say gold is quite speculative, believe it or not. Term deposits or whatever, less speculative, but then you don't get as much upside. The markets, highly speculative at the moment. bonds. I wouldn't go to corporate bonds given what's going on. Maybe if you can get government bonds indirectly or whatever, maybe. That's why the Fed's 20-year bonds, that's why the government's 20-year bonds, the Fed's buying, look so secure, because essentially they are backed by the US Fed. So, and Aussie bonds, government bonds are actually relatively risk-free at the moment. It's not easy. It's really, really complicated, and I can't develop a strategy, for you on the fly here. Do your work, look at the different options, spread your risks, but you've got to take a view. You've got to take a view on where you think things are going to get to, or you've got to at least take a view as to what the leading indicators will be to change or make your decisions. And that's why I keep saying watch the DFA shows, because we try and track what's going on in real time, and we will actually relay the best we can what's going on. Okay. Now this is the one. Cookie Boy says, could overseas lenders stop lending to Australia? Let's say it did, what would happen? Yeah, overseas lenders. So there are two scenarios here, right? Overseas lenders could be banks that are actually international based but with a local branch, right? So, the INGs of this world, right? They've got a local franchise, but they're connected to their international. So are they likely to stop? Probably not, because the returns in Australian banking for those guys is still pretty good relative to other parts around the world. Those types of organisations don't have a massive exposure, a massive share of the banking in Australia. So if they were to withdraw, it would actually give a bit more room for the regionals and the credit unions and the major banks here. So that's not particularly a problem. More of a problem would be what would happen if the big international investors stopped investing in Australian banks, because the banks in Australia are still reliant on international credit flows and the capital markets to support their book. Around 30% of it used to be much higher, but now it's come back a bit. If that were to stop, so if those international investors decide that Australia was a bad place to invest in, that could be a problem. But the banks here in Australia, particularly the big ones, are underwritten, formally or informally, by the government. And that means that most international investors regard Australian banks as government-backed entities. That's why they continue to invest in them, and that's why they're happy to pay not over the odds for the bonds that those banks issue. So that's the way I see it. Now, John says in ACT there's not enough separate house title houses. Is that why prices won't go down easily? Yeah, that's right. So if you look at the demand versus supply in ACT, there's probably more units than required, but not enough houses. And so that's one of the reasons why I made the distinction earlier on. Paul says, how should we do due diligence on a high rise? Right, so this is one you're thinking of buying or one you already own. Basically, if you are going to buy, I think it's really important to get a structural inspection and get that surveyor to look at the public areas as well, and also look at the agreements that may be in the strata management's documentation. Because the question you've got to ask yourself is, what happens if I suddenly find that there are defects? Who's going to pay? And is there evidence of poor drainage or cracks or other bad building signs? The thing about a survey is that they will only pick up the obvious things, but it's definitely worth doing. When you go look at a property, look for cracks. Most people just look past them. Look for cracks in concrete, look for cracks in the walls, look for watermarks where water's been running down the walls, look for mould on the inside. That shows more poor ventilation. I used to be a building surveyor years ago, so I perhaps know this stuff more than most. You can see some of the early signs, but you need to get a bit of due diligence there. I would never buy even a new property without having looked at the structural issues. Ultron says, what do you reckon about Steve Keen's idea to give everybody 100K? Well, it's the debt jubilee idea. So basically his idea is that we've got too much debt in the system, it's way too much, it will never get paid off, and that's going to be a drag anchor on the whole economy and everybody for a generation or two, right? That's basically his position. And he's right, too much debt. What do you do about it? So basically in the modern economic theory, you say, well, people have to pay it off. Debt is debt, it has to be paid off. You've got no choice. You will have to pay off the last penny. And people basically in Australia have full recourse. So even if you default on your property, you still have to pay the debt. Not true necessarily everywhere, but it's certainly true in Australia. So the argument is that you've got to try and break the logjam. So one way of doing that is to essentially hand money out. And if you hand money out, those people with loans can actually have those loans reduced. That means that they've got less pressure on them. If you haven't got a loan, you should still get something, because it's not fair just to bail out the people who had big mortgages and you didn't have a mortgage, or you paid your mortgage off. You did the good thing. I mean, I paid my mortgage off years ago, so I'd be a bit annoyed if those with mortgages got 100k and I didn't get anything. So I should get something too, I suppose. But then you've got opportunity to invest it, perhaps. So it's sort of about steering the wealth differently and structuring the wealth differently. It's got to say it's highly unlikely it's going to happen. The current government is still wedded to no debt, paying down debt. It's still wedded to, the private sector is responsible for, clawing debt back. And I think the sector of the economy that's going to really boom over the next 2 to 3 years will be the debt recovery services and the entities that actually buy properties at distressed rates and then basically sell them on. That's what happened in the US. I think we'll see the same here. Now, Neil says, you said gold is speculative, although if you calculate gold returns year on year, since it was depegged in 1971, it's provided a return of 573.19%, whereas stocks have only produced 424.58%. Yep, that's possibly true. The question is, where does it go from here? Like I said, if you believe that gold is going to continue to track higher, then it makes sense. If you believe that there were reasons why gold did, and those reasons have changed, and we're moving to a deflation environment, and as Harry Dent says, in the deflation environment, you've got no guarantee that gold will hold its value. It could well fall. Then, maybe the other answer, it depends. So I'm not giving you the right or the wrong answer. I'm just saying there are lots of different scenarios, and you've got to pick a point where you start the conversation, from where you measure it, and you've got to say, well, what's going to happen ahead? So, if gold's going to drop back to below 1,000, does that change the story? Possibly so. Now, this is from Robert Barwick. Hi, Robbie. If investors see our banks as government-backed anyway, why don't we start an actual government development bank to produce productive investments? Well, there you go. The idea of a public bank to actually invest in real things. Well, they probably should, actually. This is a really important conversation. We have not got banks that are fit for purpose. Banks in Australia are fundamentally big building societies and basically are just out to flog you a bigger mortgage and to pump property prices higher. That's what they do. They don't provide enough credit for productive businesses. They don't actually provide the support that's required for infrastructure investments, and they prefer to take speculative moves and go into the old derivatives and those sorts of things to make bigger returns. We need a banking system that's different from that. And the idea, I think, of a publicly owned bank that's there mandated to provide the support that's required to enable our real productive businesses to grow and develop is a good one. I've said that quite some time. We've made a few shows about it, Robbie, of course. It's a big deal. And the truth is, I think it's important that is on the agenda. But, of course, there'll be big resistance to it. And the strongest resistance will be from the private banks. Now, this is from Brendan. How are prices going to come down if real estate agents refuse to take a cut in their commissions? Will they refuse to budge until they have zero transactions month after month? Some are, exactly right. The real estate industry is full of some really good guys and some really bad guys. And some of the good guys, like Edwin, for example, who comes on the show, will tell you all about what's going on. Some of the bad guys are preferring not to share the bad news about price falls. They are preferring to talk the market up, and they're preferring to do anything to try and get a deal. Unfortunately, they are not sure that's a settled moment. So the total volumes of transactions are way down, and that means that many of them are struggling from a financial perspective. And in fact, there were some changes to the commission structures quite recently to make it less difficult for people. Yeah, it's a real tricky thing. You know, real estate agents, if they're a good one, if they know the local area, know the properties, know the market, are really valuable, but many really do very little. They tend to be a little bit flexible with some of the truth, and frankly, sometimes I think probably don't look after your own interests if you're a buyer, or indeed if you're a seller. So you have to be cautious. I would suggest, as Edwin says, kick the tires on a few different agents and figure out which is the one that knows what they're doing. Jay says, can you speak to the social consequences of failed economic reasoning and the costs of not changing strategy and this opportunity? Oh, wow. Now, you get me started on that, we'll be here for another 3 hours. Look, there is a once-in-a-generation opportunity here that's been created by the COVID to change and do things differently. There is an opportunity to understand that perpetual growth probably isn't feasible. You know, we're going to run out of planets quite quickly. There is an opportunity to invest in future projects and programs that will create real value for society rather than just for the financial institutions. And there is an opportunity to change the, if you like, the ethical basis of the way we do things. That's the opportunity. The risk is that we just try and revert to where we were before COVID and essentially throw more money at the property sector and the bank sector and basically get people into more debt and make it ever harder for people to invest for business purposes. You know, you can see this bifurcation there, right? And on a tactical basis, politicians will take the easy route because all they're worried about is getting to the next election and getting re-elected. What we need is a strategic view of where we are and what needs to be done. This is a 5, 10, 15, 20-year program, in my view, that could take us somewhere really exciting because Australia has one of the narrowest based economies in the world at the moment. You know, we dig up stuff and throw it out the ground. We've got a bit of farming, a bit of tourism, other services, education, but really we've got a very narrow basis. I want to see more manufacturing. I want us to see making more things here. I want us to see us being more innovative and, you know, frankly, creating a better future. Now, there is an opportunity. And I think if you overlay that, then the opportunity that's created by changing the energy mix to something which is more sustainable and changing the focus on investment to things which can actually add more value to the community. You know, there's a whole bunch of things we could do. So, yeah, there is an opportunity. I don't know whether those in power will step up or whether they will just revert to type. At the moment, it appears to me that they're reverting to type, but we'll push them as hard as we can in a different direction. Okay. Cookie Boy says, when's your next chat with George Gammon? Hopefully soon. We said we'd do another one in a month or 6 weeks, so it's coming up. We'll plan to do another one. We had a lovely time. That was a really good fun chat, both on his channel and my channel. If you haven't seen it, recommend it. He and I see eye to eye on a lot of things, although he has a view that the future is inflationary rather than deflationary, interestingly. He actually made a show recently about that. And Thomas says, whoa, we haven't got the leadership to manage that. I agree, that's part of the problem. Leadership is a real issue. Vision and leadership, right? If you think about great leaders, it seems to me that they take an opportunity and can actually point us somewhere and paint a picture of what it could be. I don't see any of that. It's all very tactical. It's all very sort of, do this, do that. So leadership's a problem. Now, I just want to do one thing here. So I just want to acknowledge there's been quite a few people who've been putting little notes up here. So Deep Pam, been since 2,500 subscribers. Thank you, appreciate that. I've answered the Wollongong question. Phoenix, thank you very much, appreciate that. Mickey, Tom, Wiser 2, what impact do you see immigration having on the economy over the next 2 to 3 years? Any comment on the effects of the future Chinese sanctions? And that's from Crinny1. Thank you and thanks for your contribution there. And I'll come back to the second. Rob, thank you for that. Gold-silver ratio. Okay. And do I agree with the US dollar milkshake theory from Travel in Rome? Thanks for that. Let me just start with the immigration. So look, immigration zero at the moment. And there is a really interesting observation around immigration, right? We know that immigration has been effectively the Australian version of quantitative easing for the last decade plus. In other words, we've brought more people into the country, and so the size of the pie has grown, and that means that basically the top line, the GDP's got bigger, but GDP per capita hasn't necessarily, and the consequences of high immigration has been the demand for all the resources in Australia, roads and accommodation, everything else, right? Now, migration brings in, let's say, 200,000, 250,000 per year. Some of those will buy property, some of them won't buy property, some will take rental accommodation. So it is one of the factors in terms of the supply-demand equilibrium. But to my mind, it's not the critical one, because we know that there's 1 million plus vacant properties across Australia at the moment, and we know that we're building still 250,000 new ones a year. So we've actually got enough property to meet the future demand if it was there. So the whole argument of we need migration to stoke the property sector is wrong in my view, and that's the one that the property sector is rolling out. Second point is it allows us to bring younger people into the country, and that's quite advantageous to us, because basically it means that when we've got this demographic shift towards the baby boomers and old age, I'm a baby boomer, I admit it, there's a lot of us around, so you can fill out the younger generations by doing that, because we can't do that enough, just sort of homegrown as it were. So that's another reason why migration is sometimes argued for. And the third is that you can bring lots of skills and experience and capabilities into the country and create a richer environment. So those are some of the reasons why you would do migration. But the downside at the moment is it's not planned, it's not controlled, and it's not managed effectively. So I don't have anything particularly wrong in my mind with a bigger Australia, but it has to be done in a planned way. We have to be able to actually think about the infrastructure build that we need to support it. And that's everything from water through to power, through to road, through to accommodation, all those things. And so there isn't a route potentially for some migration, but it's not as clear cut as many would argue. And indeed, there are some downsides to migration, which is, of course, overcrowding in some areas. Okay, let's have a look back over here. What else have we got? Now, I can't comment on the US dollar milkshake theory, so I'm not going to. I've had a few people point it out to me, but I haven't had time to look at it. Cookie Boy says, peaked at $925 in the room, $300 going to your charity of choice. Oh, thank you very much. We didn't get quite to what we wanted, but never mind. That's pretty good. Okay. Cookie Boy says, if we get to 1,000, it'll be like the Irishman who won the Tour de France, went and did a lap of honour. Yeah, very good. I like that. How much do I expect car values to fall, says Jack? Difficult to say. We know that the volume of transactions has dropped dramatically. It's 46% down, I think, as I recall. And interestingly, there's been a lot of people who've chosen to not buy a new car at the moment. People are still trying to flog new cars. Deep discounts are available. So I think we're going to see prices still quite low. Of course, the exchange rate's not helping necessarily, although it may be better now. So difficult to tell, really. Now, I just wanted to go back and answer a question from earlier on. So somebody asked me about postcodes 4012, 4013, 4014 up in Brisbane. And I'm just going to switch back to the stress data. And I will just find those. Let me just... None. Takes me a second to do this because this is a bit kludgy, but it's not too bad. So we've got all the postcodes in the country here. 40. 4013. I'll do those two. Apply. Right, there you go. Okay, so 4012 is Wavell Heights, and that includes Tomball and those there. And there's about 10,000 households, of which 3,600 are borrowing and 5,500 are renting. There's 1,182 in mortgage stress, 5,000 in rental stress. So that's interesting. Quite a few of those who are renting are in stress according to our data. And that gives you a mortgage stress of 11.5%, a rental stress of 54.4%. It's worth saying a lot of households are actually in the rental sector, are really finding it very hard at the moment. So that's that one. And if we go into 4013, well, there's only 2,109, of which 763 are borrowing, more than 1,000 are renting. Mild stress and mortgages, 458. Rental stress, 462. So that gives you 21.7% in mortgage stress, 22.9% in rental stress, and that gives you an average of 43.6% of households in financial stress in 4013, that's Northgate, compared with 66% in 4012. So there you go. That's the sort of data I can produce down to a postcode level if and when asked. Okay, we're doing 9:24. Okay, we're close to the end. Let me just see whether there's anything else. What's in store? Okay. We'll just pass on that one. Okay. I'm going to do this then. Let me go back to my presentation, which is there. Just a few more things I want to cover. I'm going to just to say I will cover the questions that people sent to me prior in a separate post because it's going to be too long and complicated to answer the questions. There were some really good questions there. But let me just say that there is information on the DFA blog. If you want more information about what we do, go to the DFA blog. You can sign up and basically get an alert every time we post. You can also support our work, and this is important because we make no money out of doing this. This is basically because we believe in helping people to understand and sharing ideas and painting pictures for people and sharing thoughts. So you won't find a single myopic view here. You'll find a range of views. Some of them we won't agree with. I can tell you that. Others you might agree with. So that to do that costs quite a lot. So if you can would like to support us, you can do it by Patreon. There's various levels. You can get custom specific content, and you can actually subscribe on a monthly basis. So that's worth thinking about. We have quite a few people who do that, and it's really appreciated. Or via PayPal if you want to make a one-off donation, if you prefer to do that. That also helps as well, and that's greatly appreciated. And we even do Bitcoin because I was asked some time ago. So if you want to spend Bitcoin, there's the QR code. So feel free to do that, should you find that useful. What I might just do, let's do a picture-in-picture there so you can see those. Okay, so that's that one. That's the blog. That's the Patreon page. Sorry, I didn't have the right camera on. That's the PayPal page, so you can just see that there with the details. And Bitcoin, if you want to make a contribution by QR code, that's it there. Now, we do actually also have this DFA Design Intelligent Insight today. We've put that on a few pieces of merch. It's available, teespring.com. We might update it, change them later, but we were challenged to do it, so we did. So there you go. If you want to get a DFA mug, you can. And it will have Digital Finance Analytics Intelligent Insight today. Of course, today being my catchphrase. Now, on the top hits, the Writing on the Wall post from the weekend, that got a huge audience. And that's where we started talking about the fact that so many people can't see what's going on, and yet we can. There was also the post with Harry, not the one I did last Saturday, but a couple of weeks ago, in Probably We Trust with Harry Dent. That got a very big audience, and not just locally, but internationally. Did a post on mental health and how is the mental health crisis real? Very important post. It wasn't hugely popular, but the people who actually watched it were very, very interested, engaged. So if you've not seen it, it's worth it. Basically, the theory is that there's a lot of people who are actually basically accused of being mentally ill when they're not. They're just dealing with social problems. And in fact, rather than dealing with the root cause issue of the social problems, they're referred to a mental practitioner. So there are some people obviously who are mentally ill who need help. But the point is, the truth is rather different. Down the Rabbit Hole Part 2, that's with my friend George. If you really want to go out there on a limb, Tinfoil Hat Land, George is your man. A very popular post. A lot of people loved it, just because it was different. And then done a few posts on the relationship between the US and China. I did one with a commentator who basically, he and I took a sort of a balanced view. I did a post with a professor in Canberra who was very worried about China's influence, and then Salvatore Babani, who basically is very much of the view that the US is some streets ahead of China anyway. So interesting debate. I think it's a debate we're going to have to take seriously about the relationship between China and the US. You know, look at what's happened today with the barley and the risk of other trade sanctions in Australia. I mean, this is quite serious stuff. And as I said to a commentator, it's like we've got one foot in the US camp, we've got one foot in the China camp, and the two parts are moving in different directions, and we're getting sort of stretched, and it's a question of what do we do about that? So it's worth, I think, looking at that. Okay. The next post will be on the 2nd of June, so that's basically the beginning of, I think that's 2 weeks from today. The reason I'm going to do that is there's a lot of information coming in right at the beginning of June, so I'll be able to update the scenarios. The Reserve Bank, of course, meets the next week, but that's what we're planning to do, so that's 2 weeks from today. And just a reminder of the online conference on the 24th of May. So you've got Harry Dent, you've got Robert Kiyosaki, myself, and we're going to talk through how does this all play out? What are the potential scenarios? What does it mean? Now, there is going to be some hard sell probably sometime during the day because I don't run this whole thing, so just to warn you. But there will be a chance to ask Harry and myself some questions towards the end of the day online. And you can also hear Harry talking, quite a long Harry session, I think about 70 minutes, and Robert too, talking for quite a long time about their ideas and their observations. So you'll get quite a rich view. I'll be making a presentation too on my mortgage stress and other stuff. So if you think it's useful, you can sign up. It's free, and you can go to harrydentlive.com. Okay, so that's pretty much it. Let me just come back to my main camera. I have one last look down the list and see what else I've missed. I'm sure that okay, somebody's asked me, Oakley, 3166, right, let me just go back to it, hang on, 3166. Let me just do this, put that back up there, okay, go into the filter, edit the filter, none. So I'm using a tool called Tableau, which is essentially a front end for my database. I use that for quite a lot of my work. 3166, I think it was it? 3166, yeah. Okay, 3166. Just have to go down the list. There isn't an easy search function. 3166. Okay, 3166. Apply. Okay. Okay, this is Oakley and the outer suburbs of Victoria. Right. 9,643 households, of which 3,428 are borrowing at the moment, 4,365 are renting. There's 979 in mild mortgage stress, none in severe stress, and there's 1,027 in rental stress. And that gives an average mortgage stress of 10.2%, an average rental stress of 10.7%, and an average financial stress of 20.8%. So I would say that's pretty good. Suburban mainstream is the overriding segment there. So basically middle of the road families. And I would suggest that that doesn't look too bad relative to many of the others that I've seen. Okay. How about postcode 6100? Okay, could do that. Okay, edit filter. 6100. 6100 and hang on, none. 6100 and 6101. Okay, apply. Okay, so this is now Western Australia. So 6100 is Burwood and Victoria Park. 7,497 households, of which 2,159 are borrowing. 4,557 are renting. There's 747 in mild stress. There's 155 in severe stress. The total in mortgage stress is 12%. There's nobody in rental stress over there at the moment, which is good. And that gives you a total financial stress of 12%, so not too bad. And the next door is Carlisle East Victoria Park. 7,780 households, of which 2,808 are borrowing, 4,119 are renting. Mild mortgage stress 991. Average in mortgage stress is 12.7%. No rental stress 12.7%. And one of the reasons why rental stress is so much lower in Western Australia is because rents have dropped dramatically. So a lot of people are actually finding it more affordable than previously. Okay. Mark says, can I comment on the record refinance figures as reported in the AFR? Yeah. A lot of people have refinanced to lower rates because rates have dropped, right? So that's one of the reasons why people do it. And people are actually, in some cases, going to fixed rates. I'm going to make a post tomorrow. I spoke to CanStar today and discussed with them about the issue of fixed rates versus variable rates and what the true costs are. And we'll put that up because it's going to be quite an important conversation. Be really careful about refinancing at the moment. Make sure you don't get locked in. And make sure that if you go for a fixed rate, you understand the full economic costs of doing it. But a lot of people have done that to try and reduce the monthly repayment costs, which is not surprising. That's why we're doing it. 4035. 4035. Okay, another one. I knew this was going to come at a rush at the end. I just knew it. 4035. 4035. Okay, 4035. None. 4035. Apply. Okay, so we're talking Albany Creek, Bridgeman Downs in the outer suburbs of Queensland. And mature stable family is the predominant segment. 8,749 households, of which 469 are borrowing, 2,100 are renting, 1,625 are in mild mortgage stress, none in severe stress, 102 in rental stress, and the mortgage stress is 19.1%, the rental stress is 1.2%, and the average financial stress is 20.3%. So not too bad, not as bad as some on postcodes, but there's quite a few there who are borrowing. So about half, nearly half of people are borrowing. So people are quite well leveraged. How about that one? Okay. Right. Now, Greg says, is the Sunday event going to be replayed? And the short answer is, I don't know. I've asked today to find that out. It's possible that they will, or it's possible that they might do it again, but I'll keep people informed. And that's pretty much where we're at, I think. 316, I've done that one. I think, did I do Oakley? I can't remember. 3166, I'm not sure. I'll just do it again in case I didn't. Sorry. My chat jumps from time to time, and so it's 3166. Apply. Okay. No, I didn't. Okay. Oakley South, Huntingdale. Outer suburbs Victoria, suburban mainstream. 9,643 households, 3,428 borrowing, 4,365 are renting, 979 in mortgage stress, the mild variety. Rental stress 1,027, that's 10.2% of those in mortgage stress, 10.7% in rental stress, giving a finance stress of 20.8. So there we are, 20%. Okay, so I think I'm pretty much cooked there. Thank you very much for your time. Cookie says, any new guests in the future? Oh yes, there's a few coming along. Just watch this space. We've got some interesting things going on, but I'm not going to break that today. And Bester says, agree with the fixed versus variable rate. Yeah, tried to change my fixed rate. Was going to be charged 7k for the doing it. Exactly. Yeah. And thank you for that cookie. I'll have a look at that one there. Okay. 2567. I'll do a couple more just because I like doing it. So, guys, if you want to drop off, I'm not going to do anything more than just go through the few more of these postcodes. I've got half a dozen more 2567 to do. 2567. I wanted just to illustrate how you could actually 2567. You could actually go into the granularity that we've got in the model because it's pretty powerful. Okay, so this is 2567 Mount Annan, including Harrington Park, Narrowland. Okay, now this is unfortunately one that I quite often see. Households, 12,338, of which 8,574 are borrowing, 3,256 are renting, 5,653 are in mild mortgage stress. There's 2,056 in rental stress, and that gives an average mortgage stress of 45.8%. That's well over the national average of 38%. Rental stress 16.7%. Total in financial stress 62.5%. So, and this is an urban fringe area that as I call it in my model. That's quite typical of those types out on the urban fringe. Unfortunately, that's very, very uncomfortable there. Okay, so that's that one. Noosa 4567. 4567. So people have been saying sometime I should make this available interactively so that you can go look, but I don't think I'm going to do that at the moment, partly because the information, of course, keeps changing. Okay, this is Noosa. Okay, 6,820 households, of which 1,703 are borrowing and 3,863 are renting, 153 in mild stress, 3,863 in rental stress, mortgage stress 2.3, rental stress 56.6, making total stress 58.9. Now I'm guessing that that's because accommodation up there is quite expensive because of where Noosa is and what it is. Somebody says, go from 1 to 999,000. Yeah, I think I'll just pass on that. 9770. Did I see that one there? Let's have a look. 3076. Did I do that one? I'm running out of... Okay, I'll do two more and then I'm going to stop. So if you want specific information on the postcode and it's not on the show tonight, you can send me an email to the blog and I will send you back the data over the next few days. So that's a promise. I like to share my information. 3076. 3076. Okay, apply. This is Epping in Victoria, 11,275, of which 5,921 are borrowing, 4,311 are renting, mild stress is 3,509, severe stress 0, rental stress 924, 31.1% in mortgage stress, 8.2% in rental stress. That gives a total financial stress of 39.3%. Okay. 3805. Oh dear. It all comes too late, Should have asked me earlier. Oh dear. 3805. 3805. Apply. None. Okay. This is Narrow Warren, my favourite. Okay. Another large area around Melbourne, a lot of new properties, 18,464 households there, 12,081 borrowing, 5,338 renting, 8,509 in mild mortgage stress, no severe stress ones, no in rental stress, 46.1% in mortgage stress, no in rental stress, so 46.1% in financial stress in that particular postcode. And it is one of the ones I watch. It's, one of my top ones because of the number, right? Because there's, a lot of people. So 8,509, that's a big number. Okay, one more. Let's have a look. 4511. Let's do that one, shall we? 511. You get sort of into this as you sort of look at the different postcodes and you realise just how different areas are. 4511. None. Apply. Okay. This is Sandstone Point, Goblin Beach. I've called that the Wealthy Seniors Group, so that's right or not, but that's the predominant segment that they comes up. 3,807 households of 1,393 borrowing, 1,409 renting, 199 in mild stress, rental stress 422, so that's 5.1 in mortgage stress, 10.9% in rental stress, giving a total financial stress of 16%. That's pretty good. Okay. Publish it on a website with an API to live data. Yeah, could do that, but whoops. I'm not sure I'm going to do that. Somebody wanted my email address. If you go to the DFA blog, you can send me a message direct from the DFA blog. Okay. There's too many more. I'm going to run out of smoke. Harold says 3805. Let me just do Harold. Edit filter. If you want, let me know in the comments. Would you like another show where we can actually do this again? Because a lot of people now quite keen on this, but it's a bit late, and I need to stop. So I'm going to have to stop soon. But put the comments in if you would like me to run a show specifically on the model, and I can then do more of this. That's now 3805 Narrow Warren. Have we done that one? I think I might have done that one. Fountain Gate, Narrow Warren South, 18,464, 12,081, 5,338, 8,509, 46.1. I have done it. I've done that one. All right. Okay. Now there's too many. I really can't do any more. So I'm going to stop there. So look, I want to say thank you very much for your time tonight. It's great to have so many people on and the enthusiasm. We got over 900. I don't know quite exactly what we got. I'll have a look in shortly. But let's have a look. Peak concurrent was 949. There you go. We didn't quite get to 1,000, but Cookie's going to pony up $300 anyway, so I appreciate that. Thank you very much for your time. A lot of people saying yes, another show, another model. Okay, on the 2nd of June, we will start with the model. Okay, so if you want to come on and essentially we can spend a lot of time looking at the model. I'll put some other data in there too, so we've got some other dimensionality, and hopefully we can then meet some more of those requests. So it really is very gratifying to see that people quite like it. So please, if you like the show, like this, please spread the word, and we'll be back for another show very, very soon. Take care, keep well, and I really appreciate all your support. Thank you for all those who made contributions tonight. Really, really appreciate it. Aaron, Crinan, Traveling Ryan, Rod, thank you so much. Have a wonderful evening, and we'll see you next time. This is Martin North from Digital Finance Analytics signing off. We'll see you next time.